Smart money basics. How big traders move the market. Ever feel like the market is rigged against you? Do prices seem to jump around randomly without any clear reason? It's not just you. Many traders feel the same way. Today, we're diving into smart money basics. We'll explore the strategies used by institutional investors. By the end of this video, you'll understand the real forces driving market movements. You'll also learn how to spot the moves of the pros. Our goal is to give you a clearer picture of how the big players operate. This will help you make more informed trading decisions. So, what exactly is smart money? It refers to the collective actions of institutional investors. Think of pension funds, mutual funds, hedge funds, and large corporations. These are the entities that control significant capital. These players have vast resources at their disposal. They also have access to sophisticated research and advanced technology. Their approach is based on data, analysis, and strategic planning. They don't rely on gut feelings or emotions. Understanding their behavior is crucial for any trader. It can give you an edge in the market. One of the key strategies used by smart money is accumulation. This is when they buy stock over time, often discreetly. The goal is to avoid driving the price up too quickly. They want to build a position without alerting other traders. They often use techniques like laddering orders. This involves buying in small increments over a period of time. The objective is to build a large position at a favorable average price. This sets them up for future profits. Accumulation can be difficult to spot, but there are clues we'll discuss later. The opposite of accumulation is distribution. This is when smart money sells their holdings, often after a price increase. This often happens when the price has been driven up by retail traders. Smart money takes advantage of the increased demand. Similar to accumulation, they sell without crashing the price. They want to maximize their profits. They use similar techniques, selling in small increments over time. This allows them to exit their position gradually. The objective is to take profits after a successful run-up in price. So, how can you spot accumulation and distribution? There are several key indicators to watch for. Volume is a crucial indicator. Increasing volume during a period of consolidation can signal accumulation. Conversely, decreasing volume during price declines can suggest distribution. Pay close attention to volume patterns. Also observe price action around key support and resistance levels. How does the price react when it reaches these levels? Smart money often tests these levels to gauge market sentiment. They want to see how other traders will react. Positive news can be used to drive up prices during distribution. Smart money uses the hype to sell their holdings at a higher price. Understanding order flow is also important. This involves understanding the role of market makers. Market makers are intermediaries who facilitate trading. They provide liquidity to the market. They earn a profit from the spread, which is the difference between the bid and ask price. Smart money often uses market makers to execute large orders discreetly. This helps them avoid moving the market too much. Analyzing the order book can provide clues about smart money order placement. Look for patterns and imbalances. However, keep in mind that order book data can be manipulated. It's just one piece of the puzzle. Understanding smart money strategies doesn't guarantee perfect prediction. The market is complex and unpredictable. That's why risk management is so important. Always use stop-loss orders to limit your potential losses. Position sizing is also crucial. Risk only a small percentage of your capital per trade. Diversification can also help reduce overall risk. Don't put all your eggs in one basket. Remember, trading involves risk. Never invest more than you can afford to lose. The best way to learn is through practice. Analyze charts and look for patterns of accumulation and distribution. Paper trading is a great way to test your strategies without risking real money. There are also many online resources available. Take advantage of these resources to expand your knowledge. Continuous learning is essential for success in trading. The market is constantly evolving. Stay informed and adapt your strategies as needed. In summary, understanding the strategies of big players is crucial for success. It can give you a significant edge in the market. Don't be discouraged if it seems overwhelming at first. Keep learning and practicing. Always prioritize risk management. Protect your capital. If you found this video helpful, please like and subscribe. Hit the notification bell so you don't miss future videos. What other trading topics would you like us to cover? Let us know in the comments below. Happy trading, and we'll see you in the next video.